Bloomberg Audio Studios. Podcasts, radio, news.
You're listening to Bloomberg Businessweek with Carol Massar and Tim Stenovec on Bloomberg Radio.
Let's get to that first FOMC decision of 2025. The Fed, as expected, holding interest rates steady, pausing to assess the inflation outlook following a string of rate reductions last year. In the statement released with the decision, the Fed repeated that inflation remains somewhat elevated, but removed a reference to it having made progress toward their 2% goal. Here's Jay Powell in the statement at the press conference about not needing to hurry to adjust their policy stance.
Over the course of our three previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance.
We do not need to be in a hurry to adjust our policy stance. That, of course, was Fed Chair Jay Powell just a few moments ago. We got a big program coming up. We are diving into the Fed, and let's do that. We got with us Nate Thooft, Chief Investment Officer at Manulife Investment Management, joining us from Boston. Also with us is Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey, who is not in Princeton, New Jersey. No. He's here in the Bloomberg Interactive Brokers studio today.
Ira, let's go to you first. I got to say, our Chris Yancey on our live blog, who follows the global economy, he posed this. He says, it's just logically you wonder if inflation is no longer making progress toward the Fed's 2% goal. Inflation goal, and the labor market meantime is solid, how can the risks be balanced? Which is what Jay Powell said. Are they balanced if the 2% target is still out of reach and we're not making progress toward it?
Well, I don't think, firstly, the 2% is out of reach. And look, the Fed kind of tied their hands when they went to a firm 2% target, because if inflation was right where it is today at 2.3, 2.4, depending on which measure you look at, we would say, okay, inflation's fine, right? Like, we wouldn't worry about it, except we're not at 2, right? And that's
they're sticklers on this 2%.
Yeah, and that's part of the problem. They should have kept more of a, average inflation targeting kind of thing. And I think that would have made their communication a little bit easier. But I think the important thing that came out of today's statement, and with that change in the statement, and then Jay Powell mentioning multiple times they don't have to be in a hurry, this could mean a skip again in March. And I think that that's very important, because I think there were a lot of people, myself included, thinking that, hey, the Fed would cut in December, skip January, cut in March, and then maybe be done after that, or maybe do one more. But now they're talking about multiple waits. And the longer the Fed waits, the higher the risk, I think, that the next move is actually a hike. So they can stay here for a long time, probably, at this point.
Nate, come on in here. Do you agree do you think that 2% target is actually out of reach?
I don't think it's out of reach. I think it's all dependent on your time horizon, right? The Fed has been very clear, as well as most economists, that the path to lower inflation isn't going to be a straight line. And we have seen a few pockets of hiccups here, right? But ultimately, our belief is that the trend for inflation is still down. It's just not as fast as a lot of people want it to be. And our view is that the Fed will continue to cut, even if we don't get to exactly 2%, as long as they're comfortable that the trend continues towards 2%. And at the same time, they're going to continue to be very focused on the labor market. And right now, the other comment for the Fed is the labor market looks pretty solid. We would define the labor market as fine, not necessarily solid, but it's not too hot, it's not too cold. It's okay, but there still remains risk in the labor market that it could weaken as the year goes on.
All right, Ira, let's talk about the moves that we saw in the U.S. rates market, because I feel like, is the Fed Jay Powell dusting off his shoulders and saying, okay, there was a little reaction, but we're kind of where we were before the Fed announcement. So is he feeling kind of maybe good about what was done and what was said?
Well, so the guidance, I think the market, remember, we had basically 3 events today from the Fed. So the first one was a statement, and the change in the statement, particularly that inflation statement saying that we're no longer making progress, right? Like the removal of that was taken as hawkish.
And we saw rates go up.
Right. So short-term interest rates went up a little bit. You had Fed funds futures sell off a little. You had SOFR futures sell off a little. You had 2-year yields go up about 5 basis points. And all of that's reasonable, because that means that, hey, if the Fed's done hiking, then interest rates are right where they're going to be. So everything should be at 4.3% in terms of 2-year yields and all the short-term rates. But then you had the press conference, and Jay Powell made a little bit of an about face at the press conference, particularly in after his opening remarks to a question about why the change, right? Why the change? And basically he said, well, we wanted to shorten the sentence, and we're not making the same kind of progress we were toward the inflation, but it's not a big deal, right? That's what he made it sound like, and that's when you saw rates go the other way, and everything went back nearly, not quite, but nearly back to where they were.
So is this like the Fed Twitter platform, only 140 characters, or like what? How do you read something like that from Jay Powell? Editors come in and say we got to make this shorter. What is that?
I think it's a clarification. The way that I look at the change in that first paragraph, and all of the changes were in that first paragraph, which is about the economic environment, is a marking to market.
Okay.
So just an acknowledgement that the labor market is okay, not great. I agree with Nate on that. But then the inflation statement saying that, hey, we're no longer, inflation is still above our goal, but no longer making progress. Like that means that the next logical step is it goes the other way, right? Inflation goes higher,
right?
And that means they have to hike.
Hey, Nate, I was saying to Carol before our program started, I was surprised at how much politics came up. Carol, you weren't surprised. You said it was expected.
I assumed that was going to be like, everybody was going to obsess over it.
Well, policies from the Trump administration, tariffs, disruption to supply chains, tax policy. How do you think the Fed is dealing with all of that? Did we get any clarity from today? I mean, the Fed chair was prepared for all those questions, it seemed.
Yeah, I think the Fed was expecting it as well, because it is a hot topic. And even their counterparts in other central banks, north of the border as an example, Bank of Canada, they explicitly addressed tariffs as being a negative impact to their economy. So I think the Fed was prepared for it. But I also think the Fed came into this meeting with two goals. One, to maintain as much optionality as they could. And two, not to move the markets a lot. And I think overall,
check,
right? In the conference, they balanced that pretty well. So ultimately, they were expecting it, but they weren't going to give a lot of detail and a lot of offerings as to what the policies actually mean. One, they don't fully know, but two, we don't know what will actually be fully implemented.
Nate, I want to ask you, for the financial markets, especially the equity markets, but really all of it, it's been a wild week. It could be even more as we wait a big batch of big tech earnings that are coming out after the close today and also tomorrow after the close. What's the smart equity trade right now? Is it wait and see? Is it buy the dip? Is it sell? What is it?
We still lean in on being overweight equities. I think the general fundamentals, despite where valuations are, still says be overweight equities. Maybe not as much as people have been, but still lean into that trade. So buy the dip, including tech stocks, is still our general argument for our clients in our current position in portfolios.
Ira, come on back in here. And next focal point for you when you're looking at rates, we just heard from the Fed, so that's behind us now. What's the next focal point for you?
Yeah, so firstly, additional details of some of Donald Trump's policies, right? So I think that those are going to be very important. And
which ones specifically?
Well, things, not so much immigration, we see what's going on there, but things like tariffs. Like, are we going to get across-the-board tariffs? There's a lot of different pieces of that. And then also, what kind of cuts does he expect to make quickly in terms of government spending, right? So there's not much really he can do with what's been appropriated already. That's constitutional, right? We can get into the Budget Empowerment Act of 1974 if you're really going to get super wonky. I'm happy to do that with you anytime.
No, but there's certain things that if it's already been allocated, he
can't do that, right? And the courts will come in and he'll probably be overruled, just like he was with a couple of other things. But that being said, in the future, he can say, okay, we would like to see cuts here, cuts there, and as the Republicans have both houses of Congress, it's very likely that you're going to see some programs cut. So the question is, how much of those cuts are going to be able to offset the tax cuts that he wants to do, and what does that do to the budget deficit?
Powell did get a question about the staffing at the Fed, and he said he runs the Fed at a very careful budget process, and that's all I'm going to say.
He was also asked about if he had any contact with President Trump, and he was like,
said, nope.
Nope.
He did give someone a mulligan.
He did.
I like that. I'm not going to answer that question. I'm giving you a mulligan.
I don't know if we're all nerds, but I love watching a Fed press conference and listening to Jay Powell take the questions.
Yeah, we're nerds.
Thank you. Ira Jersey, as always, Chief U.S. Interest Rate Strategist here at Bloomberg Intelligence, here in studio. I'm losing my voice a little bit.
Well, then I'm going to help you out here. Also, a big thank you to Nate Thooft, Chief Investment Officer at Manulife Investment Management, joining us
I'm choked
from
up over
Boston.
the Fed. What can I tell you?